This is Kangbashi district in China's Ordos City Prefecture. Kangbashi was built in the early 2000s with an investment of $161 billion. Kangbashi was initially planned to accommodate a population of 1 million citizens by 2023, but that was later scaled back to 300,000. So far, however, only 118,000 people have moved in, and the place wears a deserted look. With empty streets, deserted high-rises and empty homes, Kangbashi is one of the many ghost cities that have sprung up across China in the past 20 years. So why are these newly built cities in China lying abandoned? Abandoned cities are hardly a sign of a booming economy. Isn't China supposed to be this ever-growing strong economic power that is supposed to one day surpass the US economy? So what went wrong with China's growth story, and is there anything that India can learn from it? Let's take a look. After years of exponential growth, China is witnessing a simultaneous fall of both growth and inflation. China's GDP growth, which was cruising at 6 to 8% between 2013 and 2019, has fallen to just 3% in 2022. Compare this to how India's GDP growth was 7% in 2022. It is estimated that even in 2023, China's GDP will rise just to 4.7%, while India's GDP is expected to grow at 6.7%. Inflation in China fell to minus 0.3% in July 2023 to the point of deflation. Falling prices are a bad sign because this means low consumer demand, which further leads to low sales and losses, and then job cuts. Today, China's debt to GDP ratio has skyrocketed to a whopping 280%. India's debt to GDP ratio is 170%, which is also lower than that of major economies. The genesis of China's economic slowdown can be traced to when, after the 2008 global financial crisis, China moved away from export-led growth to local infrastructure-led growth. Local governments lent to infrastructure contractors and property developers. But China's property market was hit by a lot of factors, including the global pandemic in 2019, the Chinese government's clamped down on the private sector, geopolitical factors leading to Western companies moving away from China, etc. Ultimately, this led to job cuts and fall in demand for houses in China. In 2021, Business Insider reported that in 2020, China had about 65 million empty homes, which is enough to house the population of France. This crash in China's property market has had a domino effect on other sectors of the Chinese economy. In August 2023, China even stopped releasing its youth unemployment data after factory and retail sales data fell short of expectations, signaling a slowdown in the Chinese economy. China is caught in a cycle of deflation, debt, job cuts, and even lower money for new investments. India, however, has not only invested in infrastructure but is also focusing heavily on export-driven growth. From food items and vaccines to smartphones to missile systems and everything in between, made in India products are finding their way around the world. And this is reflected not only in its higher GDP numbers but also the trade balance sheet. India's foreign trade crossed $800 billion in the first 6 months of 2023, with rising exports and falling imports. What's more, China's demography has plateaued. Its working-age population is falling. Meanwhile, India is reaping the benefits of its demographic dividend and has a workforce that can propel the Indian economy to new heights. Due to the China Plus One policy of several Western MNCs, India is seeing an inflow of fresh investments in manufacturing and other sectors. While China's economic growth happened at breakneck speed, it has broken necks in its course, and today its economy is trying to keep its neck above the water due to uncertain global conditions. On the other hand, while India may be playing catch-up to China, it has successfully tided over global uncertainty, ensuring a sustainable development model through democratic means.